everybody. Good morning, everybody. Good morning, everybody. If you'd all like to take a seat and we'll get started with the pre-lunch session. Thank you for the glass tinkler, whoever that was. I hope you all enjoyed the session this morning. An early start, I apologise, but I think you'd all agree the content was pretty rich, very informative. And to that end, I'd like to welcome up to the stage all of the leads for the sessions this morning. Those of you that I know are still around. So Alex, Kathy and Stuart, Julia, Adam, Chris, and Rachel, if you'd like to come up as well, but you've got the next speaking slot directly up after, so please come on up. Thank you. This is your last chance to ask any questions you might have of the amazing IP and capability that we have in the room today around IFRS 17. Any final questions from anyone on the floor this morning before we move forward in the program? Wow, you're all experts. So please join me in thanking them all for their time and their contribution. And if you'd like to exit stage right, there's a special gift for you.
Oh, wonderful, thank you.
Thank you.
Yeah. Thank you.
Now, Rachel, don't go away. Rachel, are you being joined with your colleague here today, Leann?
Yep, I am here.
If you'd like to come up. So the next session that we have for you is Rachel and Leann to talk through the nuances of reinsurance. And I'll hand over to you. Thank you.
Fabulous, thank you. Where are our slides? Oh, I'm not able to see them. I was going to say I'm not able to see them. Okay. Welcome and good morning. So after this morning's breakout session, I think I sat through the reinsurance session and felt like that there's already a lot of knowledge in the room around IFRS 17. So today in our session, we're really going to be talking about reinsurance and reinsurance held in particular. So this was a very topical area from the very beginning, right from the exposure draft was released in May 2017. And since then, we sort of feel very much that across the globe, insurers have looked at each other, scratched their heads a little bit and went, surely the ISB did not intend for a mismatch to be possible between the reinsurance and the underlying issued contract. No way. And I think now over 2 years, there's been lots of work being done, lots of discussions have been had. And do we think anything has actually changed? No. This one. Oops, technical issue.
Is it on? It's on.
Trying to press it?
This one.
Okay, great. So do we think anything has changed? And has anyone really got a clear idea on what to do in terms of reinsurance held? So before we actually get into the challenges of reinsurance held and what you'll be facing once you start deciphering reinsurance, let's quickly have a look at where we are at today. So in the recently released exposure draft version 2, the ISB has proposed, and we'll say proposed at this point, as change to allow cedents that hold proportionate reinsurance to actually match the loss. If you're expecting a loss on your underlying, to actually be able to recognise a gain. But that only applies to proportionate reinsurance. And it is only a proposal at this point, but something that has sort of been a bit of a positive message back into the marketplace. But it is, but I guess the problem with that and the concerns with that is we're still all saying that the current amendment is too narrow. People are lobbying to ask for this amendment to be applied not just to proportionate reinsurance, really being simple quota share arrangements, but to also apply that to sort of your non-proportionate reinsurance on an initial basis and also subsequently. The other option that, that many in the industry have sort of lobbied back to the ISB on about is really, what about expanding the definition of proportionate reinsurance? So not just leave it at the point of having just quota share, like a simple 20% quota share arrangement across all your claims, but actually to be able to apply that to your excess of loss contracts, your surplus treaties, and also the quota shares with specified limits. So that's really where we're at the moment after 2 years. So given that we're now in November 2019, with still the standard due to apply either January 2021 or deferred to January 2022, or if you are a European or you've got a European parent, you might start applying in 2023. There's not a lot of time. So we really need to start facing into reinsurance and looking at what it really means for your individual businesses and your individual companies. And that's really what Rachel and I are hoping to unpack a little bit for you today, to really take you through some of the big challenges and then hopefully talk a bit around what are the options. So, setting the scene, what are our big challenges? So the first one, challenge one, is accounting mismatches between reinsurance held and the underlying cover. Challenge two, and it's never an IFRS 17 session if we don't talk about this, but coverage periods, but that's absolutely critical in terms of reinsurance. Challenge three, you're accounting for reinsurance cash flows and the measurement of those. And then challenge four, we'll briefly touch on the accounting for retrospective reinsurance. So what we'll do is I'll talk to sort of challenge 1 and 4, whilst Rachel will go into the detail of challenge 2 and 3. And then we'll come back and wrap up the session with any questions you might have effectively. So the accounting mismatch. Our number one issue, and the one that most are aware of, and one that everyone's hoping that will go away. But what IFRS 17, but how this arrives is because IFRS 17 requires your reinsurance contracts to be treated as separate contracts, separate to your underlying. In determining the accounting for it, you need to look at the actual reinsurance contract and not put any emphasis on what on the underlying issued contract that you've made where the reinsurance is attached to. So as a result, there are some intended consequences that will come out of that. And it will be driven by your measurement approaches. So we might first talk through sort of what measurement approaches are available for reinsurance held. I think call out number one is that you cannot use the variable fee approach, which you're allowed to use on your issued contracts. For reinsurance held, you don't have that option. And then, so that leaves you with the option to apply the general method, the general model method, or the premium allocation approach method as being the options for accounting for reinsurance held. And basically, the same principles apply regardless, whether the same principles apply to how you account for it from a reinsurance held perspective to how you would account for it for your issued contracts. So there are no real differences there, except, there's always an except one element, is that for reinsurance held, you need to reflect the risk of non-performance of your risk of non-performance by your reinsurer into your cash flows. So it's like really accepting a credit risk. And what we'll do is I'll talk you through that a little bit. But I think before that, in terms of to sort of dumb down the measurement approach, is there's probably two examples I could use to bring that to light a little bit. So you can't use the VFA approach for reinsurance held. So if you are a life insurer that is writing, say, traditional par products or unit-linked products, where your issued contract you are using the VFA, then when it comes to looking at what options you've got to account for your insurance held, you ultimately have to default to either a general model or a premium allocation method if you meet the eligibility criteria, which means you've naturally got a mismatch in your accounting from day one and right through the life of that contract. So your P&L will always show a difference because you no longer have that nice sort of match thing that we've got currently under 1038 that we can put in. And then for a general insurer, if you're actually writing a short tail motor book, your issued contracts, you're usually using a PAA approach. You can't assume that for reinsurance held, you can just apply the PAA approach for that risk attaching. You actually need to look at the contract terms of your reinsurance, and you might find that that a lot of the reinsurance contracts these days are actually multi-year or go longer than the 1 year period, in which case then you've got to actually implement a general model for the other side of your balance sheet. And once again, then you apply the general model, you're actually releasing your gain or loss through a CSM, which means your profit emergence profile will once again be different to what you would use for your issued contract under the PAA. So now, risk of non-performance of a reinsurer. So what is this? It's the credit risk of a reinsurer. And how do we account for it, or where do we account for it? Well, you've got to account for that in the present value of your future cash flows. And what you can't do is you can't put that through your risk adjustment. Okay, but the challenge with this part is really around how do you actually measure the risk adjustment that you're going to apply to your reinsurer. And that's up for a bit more further discussion around the market, and hopefully there will be some guidance in some point. So I would say watch this space. But just remembering that credit risk can't be applied in your sort of adjustment for financial risk. So far in terms of the mismatch, we've covered probably the first driver of what causes the mismatch, being the different measurement approaches. So I guess the second driver of the mismatch is really how one is required to account for reinsurance for the initial recognition of a net cost or gain. And the default position of IFRS 17 is generally you don't need reinsurance to offset your day one losses or gains on the underlying, losses on the underlying. And that's very different to what we do today, because today when you have a loss on your underlying, you recognise an offsetting recovery from your reinsurer. So your P&L is always insulated by the loss to the extent that you have reinsurance in place to protect you. So under 17, there are some very interesting nuances, and it ultimately depends on which bucket or what type of cover you currently have. So just stepping through in terms of proportionate reinsurance. So the definition of proportionate reinsurance is a very important one. It's where if you've ceded a fixed percentage of all claims in the group. So that's really limited to very straightforward quota share arrangements, where a reinsurer takes, say, 20% of the losses of your disability income book or your motor book. If you have one of these covers, then the latest exposure draft is proposing a consideration to be adopted by the ISB where if you have an onerous underlying contract, that means if on day one when you write your underlying contract, you know it's going to be unprofitable, that you're going to make a loss on that, then if you actually have a proportionate reinsurance cover, you can recognise a gain on that reinsurance on day one as well to match it. But then any other subsequent gain or loss needs to continue to be deferred through to your balance sheet. So that's a pretty decent outcome in a way for those who've got proportionate reinsurance. So then if we look at the middle one, where we talk about sort of retrospective reinsurance, that piece, these are really covering contracts like loss portfolio transfers or adverse development covers. So where you're actually reinsuring exposures that can continue to develop after an event or after a loss that's incurred in the past. So like your New Zealand earthquakes is probably a good example of that one. And the treatment of that is basically if you've got, on day one, if you expect a net loss, then you can take that to the P&L immediately. But if you've got a net gain, if you're expecting to gain on having done a loss portfolio transfer or enter into an ADC, then you actually have to recognise that on the balance sheet. And then really the last bucket is for every other type of reinsurance contract that does not fit into your bucket 1 or bucket 2 on that slide. It is, you've got to defer that and recognise it all on your balance sheet, and there's no choice there. Which means excess of loss contracts, facultative reinsurance arrangements, quota shares with a limit on it, surplus treaties, all goes into your balance sheet. So you do actually have a mismatch. So really it makes it harder. So I think what it means with 17 is you have situations where a group of contracts is shown as unprofitable at inception, even though when you actually do your own internal analysis, you might find it is actually profitable because you've protected yourself by entering into a reinsurance cover that responds. So it's harder to harder to assess that profitability under 17 with reference to that net of reinsurance position that we're so used to right now. So it's going to call for some changes in behaviours and changes in analysis and how we sort of look at our portfolios. But the operational challenge is that if you happen to have all 3 buckets of those types of reinsurance, you're actually going to need systems to be able to track the differences in accounting. And also the underlying data requirements will definitely be more onerous than they currently are at the moment. We did have a bit of a worked example on that, but really I think I probably talked through it. So in this one, it basically sort of goes premiums is 80. So you're expecting to get premiums of 80 on your underlying, this is the issued contract. You've got claims of 100, so effectively on day 1, you're expecting a loss of 20. So that loss on your issued contract, you would take that to your P&L as a loss on day 1. But if you happen to have reinsurance cover that's proportionate reinsurance, you then can actually put the reinsurance income or gain or recovery in your P&L to offset that. That's currently a tentative decision, so we've just got to keep remembering that. But if you have a non-proportionate reinsurance, then you actually can't book anything on your P&L. So on day 1, in terms of your net profit, you would actually carry the 20 loss, effectively. And this is a bit different so the treatment also, there are also situations where you might start off with saying that your contracts are going to be profitable, your underlying contract is profitable, and then it switches to being onerous or unprofitable, say 6 months down the track, or potentially even situations where you expect to be making sort of a $5 loss, and that loss becomes a $10 loss, then there will be, then under these 2 situations, you effectively could, so the best way to show is probably you might have a day 1 gain of $10, so you're expecting that you'll gain $10, then effectively you go, okay, 6 months down the track, assume that you will have, you're expecting to have $15 of more of claims than you anticipated. You would earn the first 10 of that through your CSM, but then you actually put 5 of it through your P&L. That's what you would do on your underlying contract basis, so for the issued contract. And then if you have reinsurance, then regardless of what type of reinsurance, you're allowed to actually book the reinsurance gain to offset that loss against your P&L. So it is actually quite different in terms of what you can do for reinsurance held and how reinsurance held responds depending on the point at which you actually hit onerous. So if you hit onerous at initial and you don't have proportionate contracts, you really need to defer that on your balance sheet. So you actually do have that mismatch on day 1. But if you come onerous subsequent to initial recognition, then you actually have the ability to match that reinsurance. Okay. And now what I might do is hand over to Rachel to talk through coverage periods.
I might stand in the middle so that I can see the slide.
Yeah.
Okay, so we're going to talk about determining the coverage period of reinsurance contracts. And let's start at the very beginning, which is when we recognize a reinsurance contract held. So this is another area where the definition of proportionate is relevant, because for proportionate reinsurance, IFRS 17 tries to allow some matching with the underlying contracts in terms of when they get recognized. So I'm going to try and show you how. So I'm going to start with the blue box on the top, and that's in the ED at the moment, so that's not in the current standard, but we hope that that will get finalized. So if we have onerous contracts that we have to recognize early, and this could occur where we are bound by this contract. So for example, we've issued a binding offer, but the contract hasn't actually incepted yet. It incepts 1st of January next year, let's say. But before its inception date, something happens and it becomes onerous. IFRS 17 requires us currently to recognize the onerous contract when it becomes onerous, even if, as long as we're bound, even if it hasn't actually incepted yet. But what the ED is doing is saying that, okay, if you have proportionate reinsurance covering that onerous contract, you can bring forward the recognition of that proportionate reinsurance as well, so that the reinsurance is recognized at the same time as the onerous underlying contract. So I've said a lot of words, but hopefully this picture helps to show you what I mean. So the underlying contract is pulled forward because we are bound by it, but we know they become onerous. We can also pull forward the reinsurance recognition if it's proportionate. For everything else, the proportionate reinsurance contract is recognized at the later of the beginning of the reinsurance coverage, whenever that is, or the initial recognition of effectively the first underlying contract, whichever is later. Non-proportionate reinsurance, however, is always recognized at the beginning of the reinsurance contract coverage, regardless of when the underlying contracts are recognized. So no concept of matching, it doesn't matter. Always the start of the reinsurance coverage for non-proportionate. Now moving to the end of the coverage period, which is where a lot of the practical considerations really come in. The key point here is that the reinsurance coverage period is not necessarily the same as the contractual term of your reinsurance contract. And why we emphasize so much on this is because actually the features of the reinsurance contracts really determine how we determine this coverage period. So what are these features that we're talking about here? So one is the type of cover, whether it's a risk attaching, losses occurring, or retrospective reinsurance. Whether we have any options to add coverage to the contract, and also the repricing and termination rights of the reinsurer and the cedant. So retrospective reinsurance is an interesting one, but we have a section on that later, so I might hold on that until Leann talks about it. And the way we assess options is exactly the same as how we would do it for the issued contracts. So for this section, I'm going to focus on the repricing and termination rights and how we assess that for the coverage period of the reinsurance contract. So the principles that we would apply to assess the coverage period of reinsurance held is the same as the ones we talked about when we're looking at the issued contracts, or our direct contracts. And we talked about this at length yesterday in the session. It's really about when our substantive right to receive services from the reinsurer and our substantive obligation to continue to pay premiums to the reinsurer ends. The difference in application, though, is that we have to consider both the reinsurer's rights as well as our rights as a cedant. So I'll just walk through an example to show you what I mean. And the practical lens about this, on this is that actually it's not uncommon for reinsurance contracts to have a continuous contractual term or a really long contractual term with some ability by either or both parties to review the price or to terminate the contract in between at some point or with a certain number of days' notice. So this is not uncommon in reinsurance contracts. So this is really important. So I'm going to try and illustrate the concept with an example. Here I've put out a simple 10-year losses occurring reinsurance contract. And let's say at the end of each year, the reinsurer has the ability to reprice for future coverage. So every year, reinsurer can relook at the terms, reassess the risk, and say, I'm going to charge you this price for next year. So what is the coverage period for the cedent? How would the cedent assess this? At the end of 1 year, the cedent's right to receive services from the reinsurer ends because the reinsurer has the right to just reassess and reset the price. But what about the cedent's obligation to continue to pay premiums to the reinsurer? So that depends. Does the cedent have the ability to terminate at the end of 1 year? And is this ability to terminate conditional? So if, say, for example, the contract says, you, the cedent, can decide to terminate the contract as well after 1 year, but only if I, the reinsurer, agree to actually decide to reprice your contract. So if I don't reprice my contract, you basically just stay in the contract. If that is the term, then that is irrelevant for the determination of the coverage period. The cedent cannot use a 1 year coverage period. Why? Because if the reinsurer does not exercise their ability to reprice, I, as a cedent, am still obligated to continue to pay premiums to the reinsurer. So the coverage period extends beyond 1 year.
And that's pretty common.
Yes.
Yeah, that's pretty common across reinsurance arrangements and how cedents have entered into reinsurance arrangements. So it is one to really think about.
Yeah. So the takeaway is that both the reinsurers and the cedent's rights need to be considered. And if for the cedent to be able to apply that 1 year coverage period, the cedent's right to terminate after 1 year has to be unconditional. So the cedent also has to have its own rights to terminate that contract after 1 year. So this is, we've included another work example in here for your reference because we understand you will have access to these slides. I'm not going to go through it because it's effectively quite similar to the example that I just went through, but it's just good to have an extra example for you to take away and just see how the principles really work. I'm going to try to spend a little bit more time on this section, which is how we account for reinsurance cash flows. And here we're talking specifically about exchanges between a reinsurer and a cedent, so which things like reinstatement premiums, reinsurance commissions, even recoveries, so things that go between a reinsurer and cedent. And the reason why I say I want to spend some time on this section is because actually this is quite different to how we currently think about it and how we would currently account for these things. So the way we account and present for exchanges between a reinsurer and a cedent depends on whether those cash flows are determined to be contingent on claims or not contingent on claims. One thing I will note at this point is that everything we've talked about so far has been in application to reinsurance held, so us as a cedent. This concept and this whole section applies equally to the reinsurance issued as well as the held. So if you have inwards reinsurance, it affects you too. So what that means is that whenever we have exchanges within a reinsurance cedent, we have to decide, is it contingent on claims, is it not? Why? Because cash flows that are contingent on claims are treated as claims cash flows effectively. So if I am the reinsurer, I would recognize that as part of my claims within insurance service expense. If I am a reinsurer, I'll recognize that with my recoveries cash flows in reinsurance income. On the flip side, if a cash flow is not contingent on claims, then I will have to recognize it as the reinsurer in my revenue with premiums, and as the cedent, I would have to recognize it in reinsurance expenses where I put my reinsurance premiums, basically. So what I would say on this slide is that this shows that how we split this between contingent on claims and not contingent on claims does affect the composition of these P&L items. And to the extent our future metrics are based on these P&L line items, this split is going to affect that also, unless entities choose to adjust for them in the metrics. Now let's see how the theory applies to some of the common exchanges between reinsurers and cedents. So what I'm trying to show here is that the way we split cash flows into contingent on claims and not contingent on claims doesn't necessarily align to how we traditionally or even contractually define these cash flows. In practice, what this actually means is that the amounts that we are used to grouping a certain way may need to be further sub-split into components that are contingent on claims and those that are not contingent on claims. So I've tried to color code them so that the light blue boxes are not contingent on claims and the green boxes are contingent on claims. Okay, so what does that mean? Now let's look at reinstatement premiums and see how that gets applied and why. So reinstatement premiums, which are basically amounts that we have to pay to a reinsurer to be able to reinstate our cover whenever we make claims. In September 2018, the IASB TRG looked at these, and the IASB staff came up with the view that actually voluntary and mandatory reinstatement premiums, so whether you have the choice or not, have different economic effects. In other words, one is contingent on claims and one is not. This is based on the fact patterns that they were looking at and they were given by the industry. So let's see what one of the examples they looked at. So this is an example of a mandatory reinstatement premium. So insurer Y is the cedent, and insurer Y has to pay reinstatement premiums whenever the insurer makes a claim. And this reinstatement premiums is mandatory, so they have no choice. And how we calculate it is based on the percentage of the claim limits the percentage of premiums, and this percentage is based on the claim limit that is used. So on the table at the side just tries to clarify what the calculation. So how should the reinstatement premium be accounted for? That was the question they were looking at. Is it premiums because it's a reinstatement premium after all? Or is it part of claims, so contingent on claims? The IASB staff looked at it and said, because the cedent has no choice to opt out, so they can't say, no, I don't want to pay the reinstatement premium, it's effectively claims cash flows, meaning that it's economically equivalent to the reinsurer charging insurer Y here premiums of $250 and paying 75%, being that percentage that was in the reinstatement premium calculation, paying 75% of claims up to $1,000 and 100% of claims above that. So it's basically the reinstatement premium is basically a reduction in claims, meaning that mandatory reinstatement premiums are contingent on claims, and therefore if the reinsurer is going to have to recognize it as part of their claims cash flows, and the cedent, insurer Y, will have to recognize it as a reduction in their recoveries.
So is that going to be a problem for many, or?
This did get some pushback at the TRG. Okay, but what about voluntary? Okay, so how we look at voluntary reinstatement premiums, there's two things we have to think about here. The first step is, first of all, is the additional coverage that relates to this additional reinstatement premiums part of your coverage period in the first place? And to decide that, we would use the same principles that we just talked about in the last section, as well as the principles around coverage period that we covered yesterday. So I'm not really going to talk about it, but the effect is, if it's not part of your coverage period, it's basically a separate contract anyway, so we would treat it separately, it's a new contract. But if it is part of the coverage of the coverage of your reinsurance contract, so it's part of that original reinsurance contract, then we have to decide, is it contingent on claims or is it not? And the IASB staff decided that because the cedent has the option, it is basically additional premiums for additional coverage. So it is not contingent on claims, and we can recognize that as part of premium. So it's additional premiums. Okay. That was the easy part. Now we're going to look at commission.
So I look at it going,
Yeah, I can see looks of confusion around the room, but let's look at what that does to commissions. To be clear, I'm talking here about commissions paid between the reinsurer and the cedent. So commissions that you pay or receive from a third party, like a broker, not part of this. It's basically like an expense. Most conversations that I have about this topic usually start with this reaction. Oh, it's easy. Of course I know whether my commissions are contingent on claims or not. I just look at the contract terms, obviously. If that is what you're thinking, hold that thought until we go to the example, because it is not it's not how we traditionally view things. This split, as I said, is not based on how we define our cash flows. It's about the economic effect of the cash flows. Okay, so I've tried to put a simplified example here with a mix of different types of cash flows. So fixed premiums of $1,000. You're expecting recoveries is a quarter share, 50% of all your expected underlying claims. We've got some volume-based commissions in there, so 10% of reinsurance premiums. And we've got some profit commission in there. So the profit commission is calculated as a percentage of profit, 25%. And just to make it really easy, profit is reinsurance premiums less your reinsurance recoveries. Okay. So the obvious ones, premiums. Premiums is premiums, it's not contingent on claims. Your volume-based commissions have nothing to do with claims. Their calculations are not linked to claims in any way. Claims do not affect its amount, so it's not contingent on claims. So what about the profit commission and the recoveries? So I've done a bit of an analysis in a table to show you in different claim scenario, how much recoveries do we think we're going to get from the reinsurer, and therefore how much profit commission we would be entitled to under those scenarios. So look at the total payment column to the cedant. What is the minimum amount we think we're always going to get from the reinsurer, no matter what? In every claim scenario, it doesn't matter how big or small our claims is, there is a minimum amount we will get back from the reinsurer. It's $250. There is never a point at which we will get less than $250 back from the reinsurer, not even if we have 0 claims. So this $250 is not contingent on claims, because the $250 is what you always get regardless of your claims experience. And one of the things I'll pull out here, and this is where it really breaks how we define our cash flows, we say, oh, but what if our profit commissions were 0? We got claims of $3,000 and therefore get $1,500 of recoveries. That $250 comes from your recoveries. Of the $1,500 of recoveries we're going to get back from the reinsurer, $250 is not contingent on claims. So what does that actually mean for our P&L? So as I said, not contingent on claims, recognized with premiums, contingent on claims, recognized with recoveries. So in the reinsurance expense side, let's start with the easy ones, reinsurance premiums of $1,000. So this is cumulative over the coverage period. So I've just done one at the end of the year. Let's say, what do you see? So you see $1,000 in reinsurance expense, less any cash flows that are not contingent on claims. So the volume-based commissions go there as well, of $100. And I'm going to park the $250 for now. Ordinarily, when we incur our recoveries and our profit commissions, we would put them in our recoveries, we would put them in P&L as they're incurred. So I highlighted in blue what we expected, which is $500 and $125. So let's say that's actually what was incurred. So we put $500 and $125 in recoveries. But actually what I've established is that of the $625 that we've got from the reinsurer, $250 is not contingent on claims. So we have to pull out of that $625, $250 from there to put into reinsurance expense with our premiums. And that is where it's different to what we have now.
Does anyone still want to be an insurance accountant after that?
If your eyes are glazing over at this point, don't worry too much. You will have the slides. You can look at the example again. There were just three real key takeaways I wanted to bring out from doing this example, which is 1, reinsurance recoveries and commissions that are linked to claims may have components that are not contingent on claims. So don't just think because, it's a profit commission, obviously it's contingent on claims. No, not really. Second key takeaway is that these are amounts that we don't currently have to identify. So it may not be, so we've established it's not your expected recoveries. It may not even be your expected profit commissions. So because we don't have to identify them now, it's probably not going to be an amount that is readily available. So thirdly, what that means is that a new step is going to need to be put into our process to be able to identify that $250 so that we can put that in the right place in the P&L.
And then operationally, your underwriters and your business people are going to say, of course I know how to calculate my commissions. Of course I know whether it's contingent on claims or not. So it's going to be up to the accountants to be educating the operational guys of this accounting treatment.
Yes, good luck. Okay. So this is what we've covered so far. I've explained how to identify this amount that is not contingent on claims. In some cases, it's easy. In some cases, it's not as straightforward. Now, I'm going to throw in one last bit of excitement in here, which is the investment component. So of the 250 that we just identified in the last slide, part or all of it might be an investment component, like a deposit, effectively. And the definition of an investment component that's in the ED at the moment is that it's an amount that is repaid by the reinsurer to the cedent, or well, it doesn't really use reinsurance cedent, but that's repaid to a policyholder in all circumstances. So if you're always, in every circumstance, going to get back 250 from the reinsurer, it is like a deposit. So like a bank loan, basically. And what that means is we have to exclude it from P&L. It's a balance sheet amount. We shouldn't be recognizing as the reinsurer revenue or expense from it. It's described differently in terms of the financial impact, but effectively that is not different to what we just did with the not contingent on claims component. So if you remember what we did, we stripped out 250 from recoveries and reduced premiums by 250. So we're effectively stripping it out of P&L. So financially impact, there's no difference. But the difference is that why we have to differentiate between what's a not contingent on claims alone versus what's an investment component is because the investment component has to be explicitly disclosed in our roll forward table. There is a line in the table for investment components which we have to pull out. The other thing I wanted I remember I touched on, I said that part or all of the 250 may be an investment component, so we can't just assume the whole 250 is an investment component because it's an amount that has to be repaid in all circumstances. If, say, there is a provisional commission, so let's say at the start of the reinsurance contract, as part of the contract term, the reinsurer say, okay, instead of 1,000 of premiums, don't pay me 1,000, just pay me 950 because I'm going to take off 50 of profit commissions that I assume I'm going to have to pay you at some point. And then at the end of the coverage, we'll do a true up for your actual profit commissions, and I'll just pay you the difference. That provisional profit commission of 50 that was paid net of premiums is not an investment component because if the cedent never paid it to the reinsurer, there's nothing to repay back. So what that means is of the 250, you then have to identify how much of that is an investment component. So in that case, the 50 is not 200 is, 50 is not an investment component. It's still not contingent on claims, but it's just not investment component. Why? Because we have to take that 50 and put it in the line in that roll forward disclosure table. Right. So there is a bit of a debate in the market at the moment as to whether investment component applies to both issued and held, because in the standard itself, investment components are always talked about from the perspective of issued contracts. And when you get to the reinsurance held section, it's actually deceivingly thin. It just says everything applies to reinsurance except for these 6 things. So we hope that that will clarify in the near future. But what I would emphasize is that financially, in terms of financial impact, it doesn't matter whether it's just not contingent on claims or investment component. It matters for your disclosure. And the fact that you have to identify amounts that are not contingent on claims definitely applies to both reinsurance issued and held. Sigh of relief. Second over.
That is not an easy concept, I think. When we were first drafting up the slides, I think the first time I looked at it, I kind of went, oh, how can we simplify? And I think Rachel's done a fantastic job trying to simplify that. There's numerous worked examples and everything, but this is probably as simple as we can put it. It's something that I'm hoping that everyone will take these slides away. And if you find you've got those situations, if you remember, all you've got to remember is just the terms, reinstatement premiums. All right, we've got to do something different. That's actually all we are hoping that you guys can take away from that. Just know where to look and know that something is different. And you do have to think about the new concept of contingent on claims and not contingent on claims as part of the accounting treatment for reinsurance held. And look, accounting for retrospective reinsurance is going to seem really easy compared to all that. So really, your accounting for retrospective reinsurance, I sort of touched on that a little bit when I talked about the mismatch under Challenge 1. But effectively, to recap briefly, retrospective reinsurance is where you've got reinsurance covering an underlying liability which has already occurred in the past. And your reinsurance is covering the losses that continues to be reported or continues to sort of arrive. So really a typical example is what I'd said before, an ADC cover. And for these contracts, the coverage period is key. So where you enter into any of those contracts, the first thought is, okay, what's my coverage period? And really what we're here is, in this example, I think we've got a coverage period, we've got a period, they're expecting the claims to continue to come through for the next 5 years. So in which case, in terms of a coverage period for this type of contract, it's going to be the 5 years. So it actually is a term to settlement, the term that will take for you to settle that claim. But, and there's always a but when it comes to IFRS 17, is that the treatment, we've got to be cognizant of the treatment depending on whether you are the cedant or whether you are the reinsurer. Because it will have some consequences, and particularly if you are reinsuring through a captive. And like many these days, you tend to have a captive reinsurer, and so this is where you could end up with a bit of a mismatch that you probably weren't, that you currently don't see now. So in terms of the accounting for retrospective reinsurance for a cedant accounting, as an illustration, you would start off with probably reinsurance premiums. You get reinsurance premiums of 200, and you're paying reinsurance premiums about 280, and then you actually expect to get reinsurance recoveries of 250, but that earning of the reinsurance recoveries is actually over a 2-year period. So it's a 2-year settlement term, so 2-year coverage period, and you will earn that probably year 1 you expect to get recoveries of 200, and then in year 2 you expect to get recoveries of 50. So then on initial recognition on day 1, you'll see that you've actually, as a cedant, you are expecting to get a reinsurance expense of 30, because you are paying 280 in premiums, and you're only ever expecting through the life of that contract 250 to come back. So on day 1, you know you're actually going to be paying more. So you've got an expense. So that expense you will recognise immediately in your P&L. Okay? And then in subsequent years, we've shown in this diagram basically a profile of how we're expecting to see how you're expecting to see that profile to run off. So in terms of P&L, day 1 you've got 30, year 1 you've got 200, and year 2 you've got the 50, and you'll find that the reinsurance income and expense is matched in year 2 and year 3. But in year 1 you are actually taking a day 1 loss. So that's a relatively straightforward concept compared to what we just went through. So, okay. And so on the reinsurance accounting side, okay, so we start off with the cedant, and then say on the reinsurers, and that cedant actually is reinsuring through a captive, so a related party. When you are a reinsurer, what you do is you expect to get, you basically expect to see a gain on initial recognition. But when you've got a gain on initial recognition of that 30, same cash flows as before. If you're a cedant, you're expecting to make a loss. So that means as a result, the reinsurer expects a gain of 30. You don't take that through your P&L. So instead, what you do is you have to earn that through your balance sheet over the period of time. So hence, for reinsurance accounting, you actually end up with the middle table on the P&L, which shows insurance revenue. Year 1, you get 224 because you're actually wrapping that 30 in there, and then revenue of 56, and then you continue to have an insurance expense of 250. Being the amounts, the recoveries that you basically pay out to your cedant. So you've actually got, so you still come up with a total over the life of 30, but it's just that the way you recognise it through your insurance revenue line differs to what you'll see, what the cedant would actually be doing. And what we've done is we've tried to compare, sort of put the two tables next to, below each other, below each other, so that you can actually see the differences in profiles. And which means you've actually got an automatic intercompany mismatch if you've actually reinsured through a captive. And really, I think from retrospective reinsurance perspective, the biggest takeaway here is the impact is really, the mismatch only arises if you are actually are doing reinsurance. So it's less of an issue if you've reinsured with an external party because you're actually only focused on your own accounting. But if you happen to be a group where you've actually got reinsurance going through a related party, then you've got to be cognizant of that because it does give you a natural mismatch.
One thing to remember though, that because the coverage period for retro is this claim settlement period, and we treat that as unexpired, if you are trying to do PAA eligibility assessment, that is your coverage period, your settlement period.
Which means you can't use PAA.
You might be able to. You have to do the test.
We've got to apply the test. Okay. So what we might do after that is probably
you could prop up. We thought we'd close by just propping up that slide again of the 4 big challenges, just to bring it all together.
Do you know how to do that?
If we can go backwards.
I thought there was a trick without having clicked back through our slides. I can't do it.
Sorry, we should have planned this one better.
So what we want to do is just basically bring back the big 4 challenges and to give it a bit of a wrap up. I could just talk to it. So effectively, like today, what we've covered off is basically 4 challenges. And just as a bit of a recap, the first one was the mismatch in the accounting. Key takeaway there, just remember there is a mismatch in your accounting. It's not going to be the same as what we currently have. And then Rach, your coverage period.
Yep. So as I said, it matters if you're trying to apply the PAA and want to know if you can do it automatically or what the coverage period is. It does matter. So I guess for both 2 and 3, the key takeaway is look at your reinsurance contract terms. They are important. You can no longer say, I'm finance, that those contract underwriting has nothing to do with me. It does affect your accounting.
Mm-hmm. And then on the retro reinsurance, it's just really be cognizant that you could have a mismatch if you're actually you've got a captive, and also be conscious of the coverage period in which your retro applies to, which that reinsurance contract to be accounted for. And ultimately, really, the devil is in the detail in this standard. But these challenges means that what we're really needing companies to start thinking about is actually work out how you're going to tackle the data, how you're going to tackle or how you're going to track the data that you require, and also start doing a stock take of the reinsurance arrangements that you've actually got in place and trying to bucket them into the types you have. So if the standard does go down that route, you actually know what your implications are. And also understanding what information you've got readily available, start educating your operational guys, start talking to some of your reinsurers about opportunities to restructure arrangements that could give you some outcomes. And certainly I think in the reinsurance session this morning in the breakout, we sort of asked the question around whether we're seeing any to the reinsurers, whether we're seeing any cedents come to them, and really I think the response has been there's really minimal, which only has one telltale sign, is that as cedents we are currently not really looking at our reinsurance held and the accounting implications and potentially what you can do strategically strategically to sort of manage your how you want to present your financial statements to investors. So we really urge you to tackle the reinsurance held head on and defer no longer, because the standard really isn't that far away. So
open to questions.
If anyone's got any questions, can I ask Rachel?
Thanks very much, Rachel and Leann. We do have questions that have come through Slido, so we've got about 3 or 4, and bear with me, we've got a few minutes remaining. Okay. So the first one, reinsurance is placed internally within the group. Should we have a risk for non-performance of the group?
I think you still have to. I was going to say it depends. I think you still have to factor it in. But the standard does actually need a factor for non-performance. And as I sort of said before, the challenge is going to be measuring that. non-performance. And so it will be open to people sort of have a think about how you would, like what you would give, but you look at your credit rating, you would have to think, you still have to think about it. It's not just one that just because it's an internal reinsurance arrangement, you can go tick, move on.
Another really good question here. An entity places all reinsurance internally to the group, and then group places it, that is the reinsurance, externally. Do we factor non-performance external or only group?
But both.
Both. Both.
Another question here. With RI contracts like stop loss or XOL, they would always be onerous unless we have an underlying loss due to CAT, CAT or other events. How does the standard apply?
So reinsurance held, so if you're the cedent, reinsurance contracts are not onerous. So net gain or net cost, it doesn't matter, unless you are a proportionate reinsurance covering onerous contracts, which a stop loss or XOL is not. Then you would have to hold that net cost or net gain, whichever it is, on the balance sheet and spread over the reinsurance coverage period.
So basically defer it in your balance sheet. Yeah, and you don't have onerous contracts from that.
Yeah,
from that angle.
Reinsurance contracts are not onerous.
A couple of more questions here. How do you think this will drive business decisions? More QS being brought to fit the standard. Is that commercial sense to have a standard drive business, or business drive the standard, I guess?
It's never, like I always say, it's never commercial sense to have accounting drive the business. But I think in these cases, it's going to really depend on how ultimately, as insurers, you're going to measure profitability and whether the fact that the standards changed, whether you think there is opportunities to do different things. And I think when you report, everyone's got different objectives in financial reporting. I think this morning we talked a bit about sort of if you are a branch of a foreign insurer, you probably care less around what the accounting outcomes are. So you'll probably continue doing business the way you always have. But then if you are a listed insurer who's got investors, analysts analysing your results, you probably will care a lot more around what those results are showing and what those results are telling. And so as a result, as a cedent with listed, you might actually want to look at opportunities, if it makes business sense as well, to tweak things in your arrangements to get you certain outcomes effectively. So it is going to, so I think that's a hard question to answer because it really does depend on what your motivation is in terms of the results that you're presenting.
We've probably got time for one more question before I thank you, and I'll pick one here around mismatch on consolidation. And does this result in an actual mismatch on consolidation, or do you manually have to fix it up as an adjustment at consolidation?
Well, let me use the retrospective reinsurance example as a way to talk about this. You're supposed to take out the whole internal transaction in your consolidated accounts. So it means that you have to reverse out all of those mismatches for your group, because the whole transaction effectively doesn't exist in your consolidated accounts. It never happened.
Ladies and gentlemen, please join me in thanking both Rachel